All right, welcome to day 2 of Anomaly sequence. If you've made it past day 1, that was quite a relative easy day. All you had to do was sit back, listen to me kind of speech through this motivational area to lock in. Today, we're going to be going over some chart work. I want to introduce you guys to a couple of core foundation concepts that I believe are very important in order to get the right workflow, get into the right zone, and make sure that you become a lot more efficient on your charts. What we're going to be talking about today in the second day of Anomaly sequence is also making sure that you get the right thought process behind the charts, right? I want to make sure that whatever school of thought you have come from, that we can automatically already rewire that is as early as possible in this boot camp, in this sequence, right? The reason for that being is because there's lots of flawed concepts that are going around the space at the moment, which is just very difficult, in my opinion, to kind of relate to because there's no logic behind it. It doesn't make like concise sense because it is just some sort of belief that you are just forced to accept. So what I'm going to be doing in this video is do one of two things. I'm here to clean up your charts, which is what I do in AO and what I do in Exodus as well at the beginning, but a lot more in depth. We're going to do a little bit of that because I'm a huge firm believer of the fact that if your workspace is clean, or at least you've got everything decluttered, or you're coming to the charts with a fresh approach or some sort of mindset that everything is in order or intact, that you will perform a lot better, right? Just like at home and at your wherever you are, whether you're still with your rents or not, your room as well is a very good analogy and kind of image of what type of person you are. Is your room organized, clean, cluttered? That also kind of means that in your own thoughts, you don't have a lot of space, or let's say room to really pan out your thoughts, or to really give yourself that room that you need in order to think critically and to really take action on the ideas that you have. So the goal here, especially in this second day, is to go over basic market dynamics and to make sure that your thought process is as efficient as possible, right? The main issue that I see, and that I see with some of my students as well, is that you will have an idea, you will have the entire bias, you will have gotten your entire top-down analysis, but you just don't have that, there's too much of a gap between your ideology and your execution, right? And we want to make that gap as small as possible. We want to narrow it down, because if the gap between ideology and execution is small, you can learn a lot quicker, but you also get feedback a lot quicker, and you will ideally progress a lot quicker. If you know that you have a strict, clean, efficient trading plan, and all you got to do is collect forward testing data to see whether or not it works, you can't have that thought process where you're stuck between guessing whether or not you need to shoot this trade, or kind of creating that gray area of what is my bias, what is my strategy. So we're going to be doing that today. We're going to be tackling out pretty much kind of going through the rough patches of what do you need in your analysis, what is important to look at. We're going to go over market dynamics, a little bit of candlestick theory, going over where you might come from and what we're doing today. So let's go right into it. What you see in front of you is the Euro USD ticker, right? Shouldn't be new to majority of you. If it is, this is a representation of the exchange rate of the euro versus the dollar. So I'm very heavily oriented on Forex trading. You will see that there are other people that trade indexes like the S&P, Dow Jones, right? ES, NASDAQ, all of those things. I personally haven't really dabbled much on futures or indexes, right? There's a reason for that. There is an advantage to that if you are coming from a background of trading stocks, right? The main purpose of a stock in a company is to obviously increase in value. So your orientation is more fixated upon up only, right? And That's the same quotation that I have with Forex trading. Buying, in this case, is more safe, right? Your goal and the goal of this economy is for it to grow, is for it to increase in value, right? The European economy, whether that is based off of fundamental stuff, such as fiscal and macro policies, or based off of technical analysis that we're doing as well, or psychological analysis. Each of these three backbones, you got to understand that it's a lot bigger than what you and I are doing. You and I, we are retail traders. We are irrelevant to the space. We will never have an influence on the market. At least I could say with confidence that you might not. I have had the ability to swim amongst the same, let's say, participants that do have market making capabilities. So on direct market access, which is super cool. And I'm obviously in this great location here, the Amsterdam Stock Exchange. So as well, I've had the honor and the privilege to trade amongst veterans, to trade amongst guys that have been in the trading pits and brokers as well, and dealing desks as well. So all that cool stuff. But you and I were trading CFDs, contracts for differences, in such a liquid market. Liquid in the sense that there's lots of volume, right? There's roughly a daily turnover of nearly 7 trillion. We're going to get the report this year in Q4 from the International Bank of Settlements, the IBS. We're going to do a report this year again to showcase exactly how much it is. But we've been at these trillion figures for the last 10, 15 years already. So nothing changes in that. There's a lot of it which is algorithmic, right? Which entails that it's like matchmaking algorithms, but not. And this is the biggest myth that I want to debunk. If you're here and you're coming from a school of thought such as ICT or SMC, completely flawed, doesn't exist. IPTA is not something that is there. Investment banks don't use, there's no central delivery algorithm. That's one thing that I want to debunk. If you've seen my liquidity videos, I definitely do recommend you to go into those videos alongside this sequence. That's where I really go into very in-depth explanations on what it all means when it comes to liquidity, running liquidity, passive liquidity, active liquidity. We will be dabbling upon those much later in this sequence when it all makes sense. But at the end of the day, you have got to understand that these currencies, they're economies. We've got 181 different economies in this on this floating rock in space, on this globe. And what I do is I trade two of the most liquid pairs against each other, currencies as a pair against each other, which is the euro against the dollar. So it's the valuation of the euro. So with 1 euro, if I have 1 euro, one coin, at this current rate, how many dollars can I get back from it? And that is $1.17, right? Physically tangible, right? These points that you see here, where my cursor is at the moment, kind of floating around here, where my crosshair is, that 5 points behind the decimal point is for us irrelevant as a human when we see it, as cash, as fiat, right, as cash. But it is very relevant when it comes to trading and the investment banks and pretty much, whether it's high frequency traders, investment banks, hedge funds, all of these things that will be trading upon these decimal points or even ticks, right, nevertheless. So what is our goal and what is the objective? I'm just going to take a quick sip of coffee, bear with me. So the objective of Forex is pretty simple, right? It's the valuation of one currency against another. In this case, the economy of Europe, right? The euro is not represented by one country. It is represented by the entirety of Europe, the Eurozone, right? Versus the United States dollar, which is obviously represented by one country, but the grotesque of the US is huge. The influence of the US is huge. It's pretty much the two biggest demographics, right? Aside from Russia and the Russian ruble, the two of the biggest demographics against each other. You obviously also have the Chinese yuan, but that is very difficult to trade with the regulations when it comes to over-the-counter trading, so we won't go into that just yet. That is a case study that we can go into in the future. But but I'm not too worried about that just yet. So it's two of the major economies against each other, the euro versus the dollar, the valuation of the euro against the valuation of the dollar. So if for any reason, and that is usually long-term fundamental analysis, for any reason, if the euro appreciates in value, it will then obviously then cause the dollar to depreciate because investors and these market maker capable participants will find it a lot more interesting to transition and position themselves into, let's say, euro-based investments, or central banks going into national banks holding foreign reserves. It's a whole bigger thing than just IPDA and an algorithm and all that good stuff. At the end of the day, it is factors that will deem price of this exchange to be relatively cheap versus relatively expensive. You and I, we are humans as well, human psychology. When you are behind decision making of an exchange rate, you're also looking at factors such as when is this exchange rate considered favorable to position yourself into buy side, and when is it favorable to position yourself in sell side. This is the first loophole. When you are shorting an exchange, right? You and us on CFDs, we're in our MetaTrader, we're clicking buttons. When you short it, you don't have the tangible exchange to give back to your broker. When you short Euro USD, you don't have dollars to sell to your broker, right? So what are you actually doing? When you go short Euro dollar, you're buying up dollars, right? At the end of the day, it's always a game of demand. It's always a game of demand for one currency against the rest. So when you go long EU, what you're expecting is the valuation of the euro to increase, right? When you go short EU, right, that actually equals the valuation of dollar to increase. So you're anticipating the dollar to strengthen, right? You can inverse it and you can trade USD euro, which is what you often see traded on the tick ladders on CME and on ICE as well, or aggregated data from liquidity pools, liquidity aggregators, or interbank markets, right? So understand that when you are shorting Euro USD on your MetaTrader, what you're actually doing is you are buying up dollars, right? You're doing the opposite, right? You've got the A of your pair and the B, and what you're essentially doing is buying up pretty much your secondary currency of your exchange, right? Not that difficult. You should be able to wrap your head around that. Because you're not a central bank, you don't have foreign reserves. But if you were, let's say, and you were speculating that the exchange euro dollar will go down, you would be topping up your reserves of dollars, right? Instead of selling your euros in that case. Obviously, it's zero sum in that sense of the grander scheme of things. It's not zero sum between you and I. Maybe in a broker, it is via an electronic communication network, via ECN, your orders will be matched. So if I buy, and we're on the same broker, if I buy at market execution and you sell, it will bundle all of these orders together depending on the bid and the ask, the spread, right? And then match everything internally. That's great. But on the grander scheme of things, it's people trading hundreds of millions, if not billions, if not hundreds of billions, right? If you have a trillion-day turnover, to get to that point where there's actual movement and actual fluctuations in the price of the exchange in this quote that we see here on the right on our y-axis. So let's kind of talk a little bit about just market dynamics, right? We're on the 15-minute time frame. What we're looking at in front of us are candlesticks. Candlesticks shouldn't necessarily be something new for you. If they are, I would definitely just recommend going through candlestick theory. Why do we use candlesticks over any other type of chart that you can have, right? You can have a line graph, you can have Ichimoku, you can have Heiken Ashi, all of these type of things. But at the end of the day, candlesticks show you the most amount of information, right? They show you the open, they show you the low and the high and the close of that candlestick, of that fractal time frame, right? So what we can see with these candlesticks, and you can see I've got quite a nifty indicator here on the right that shows a higher time frame fractal on a lower time frame chart. But without going into those just yet, the consensus of a candlestick here. So if we take a look at this, pretty much this indicator here and this candlestick here, and I want you guys to get good at this early on, this fractility. So what that entails is price is fractal, right? Everything that you see on a specific time frame can happen on other time frames, and they all have this interconnectedness between them. So if you're seeing stuff form, consolidate, and that entails price moving sideways, you can kind of understand how you should start already as early on as possible. And that's kind of like this underrated skill that I teach my students as well. Understand how this is going to be looking like on the higher time frames, because then you don't need to be switching through time frames as often as possible. I want you to be as efficient as possible. Remember, I want you to become very, very self-sufficient, and also I want you to like best understand your workflow while we do this, while we go through this sequence. So without going too much into trends just yet and what it means for price to expand, for it to retrace, or for it to reverse, we're not going to do that just yet. We're going to do that in the next couple of days. But I want you to understand is that we're looking at candlesticks. Candlesticks come in two forms, an up candle and a down candle. Shouldn't be too difficult to understand. An up candle is a bullish candle, right? We talk about the cool analogies, bullish, right? The bull, the reason why it's bullish, if you ever wanted a cool fact, is because it takes its horns and it, sweeps upwards, while a bear has its claws and it sweeps downwards. Cool. Fact of the day. Now you know that. So bullish candles, what they entail is that there's buy-side momentum. It just means that buyers are more, let's say, in control, are more prominent than sellers at the current price point. So you can see here, if this is our H1 candle, right? You can see that buyers are more in control at the moment than sellers. It means that more buy orders are being filled at current prices and are being respected in that sense. Whereas with sell side, we have the opposite. So that just means that there's more sell side momentum as well. This means that sellers are more in control of the market. It means that buyers cannot buy the price up, and sell side is being absorbed and pushed through all that buy side momentum. Vice versa with buy side against sell side. So it just means there's more of one specific side of these market participants in control, right? And don't overthink it just yet. You don't need to go in the whole rabbit hole of, yeah, but who and where and can we see them? And how can we see them? And how can we trade with them? That's kind of where you go into the whole rabbit hole of trying to trade like the banks. You're not a bank. You're never going to be able to trade like the banks. Stop trying to find institutional order zones because they're not there, right? Everything that you see on the chart, everything that you do on this screen, is technical analysis. Technical analysis is always something that will be behind the facts, right? You cannot make price, so there's no point in trying to predict it, right? And that is kind of the key conclusion of this first video, of our first wake-up call on this anomaly sequence. Is we're not here to predict what the market is going to do. Your edge lies in the reactions, and those are going to start off as a very mechanical type of way of entering the market, and further down the line you will become a lot more discretionary because you've built up that experience. Like what I do, and what I've explained in the first video, is that I'm a very intuitive trader, but I've got 8 years of experience. I've seen these patterns happen over and over again, and I can blindly trust pretty much my own edge. And I know my risk management is very much intact. So I can be more aggressive. I can be more deviating from this textbook trading plan. But what we're going to be doing for you and building up for you is understanding where you got to react and how. It's like building a playbook, right? You get all these tools. I'm giving you these tools where we're going to understand these are potential models, entry models. And from there, I also want you to build up the narrative to do that. Otherwise, I could have just given you a PDF and said, here, these are all the different ways that I enter the market. But you would then be only trading these patterns every time you see it. And that's not how it works. That's not where you get the statistical edge that I have. The statistical edge comes from all the work that we do up until that point of applying that entry pattern. So coming back to candlestick theory, the thing that you really want to be looking at is the candles have two things. They have bodies, right? Candle bodies, and they have wicks. So wicks, when it comes to just understanding how they are formed, are the thin lines that you see above and below a candle, right? And there are guys out there which are very, very good by trading wicks, just wicks, right? And I've definitely seen guys be very, very successful just understanding wicks and wick fills, and you can build a whole strategy around them. Ideally, what you want to understand is just the theory behind wick, right? What does it mean? It means that sellers try to push price this far down, but buyers stepped in, right, and absorbed it and actually managed to close the price higher. It's still a bearish candle, right? It still means that sellers are in control, pushing price lower, so there is demand for euros here, right? Or there is, demand for price for the exchange to go lower, so that new market participants can step into these prices at a cheaper rate. Again, what we said at the beginning, we want areas where price is considered cheap versus areas where price is considered relatively expensive. So you can already get a very nice conclusion here that above old highs and below old lows, there's gonna be some sort of reaction. Why? Because human psychology sees, hey, it's like you go to your grocery store and you see like, oh, now the fruits are cheaper than they were yesterday. You're going to be more incentivized to buy them. Likewise, when they're too expensive, you're going to be like, well, none of that, right? So you see that above these areas. And that's where the technical analysis comes so much hand in hand with this narrative that we buy. This logic that we try to formulate, and the way that I want you to formulate this logic, rather than just blindly putting in patterns left and right without actually understanding what market dynamics are. So market dynamics like this, you understand candles, you understand candle bodies, and then you will be looking at wicks, right? So that's literally just the start that I want you to do, is to look at these two in conjunction with each other. Start building a narrative, right? Start looking at higher time frames, and start just looking at order flow. Right? What can you see, right? And what I really ask you to do, if you look on H1, let's say, huge position here after Jackson Hole, lol. What I want you to do is look at what makes most sense, right? You have these consecutive buy-side candles, for example. What would that relatively mean? Very much of a one-sided movement. If there's a one-sided movement in the market, it also means that not everyone had the fair chance to participate. All these buy orders, right, didn't necessarily then get matched with sell orders, right? Whether it's central banks, investment banks, all that good stuff. So ideally, you have this area where price is considered to be transactable, where all market making capable participants will have the chance to transact. And that is exactly what our goal is. We're moving from areas where price is transactable, liquid, to areas where price is illiquid, right? Finding displacements. And these are all terms that you're probably writing down and you're like, okay, wait, Max, you're going way too quick. Slow down. Bear with me. We've got so much more time together. But I'm warming you up. I'm warming you up for just the basics, going over it, setting up just your charts a little bit. And that's what I want to wrap up here. A couple of things before we go into anything. So we focus on candlestick charts. The next thing that I want you to do, and kind of what I do with Exodus and with AO, is clean up your chart, right? You want to be as efficient as possible, and you might call it cliche and whatnot, but I'm a huge firm believer of just making sure that there's no real psychological tilt that you can go in. So having very mundane chart colors, right? You can see that I've got white and I've got black candlesticks. I also don't have P&L tools that are red or green, right? All these little things, as much as they might not mean much to you, it's subconscious. Make sure that your subconscious is just in order, is tapped in. So one of the things that I like to do is the first thing, if you go to your settings here and you go to your grid, is get rid of your grid line, less noise on your charts. It's none of that. The background of what you want to be doing is just have a solid background. Some people If you're still on dark charts, totally okay. But honestly, I've found myself perform a lot better on light charts because it just hurts your eyes just a tad, but you're also just a little bit, you see the information a lot more. It's a lot more natural, right? We've been growing up with papers being legible, writing on um, a light background rather than a dark background. So that's two things. This pane separator, you want that gone as well. Trading, your alerts, right, and events, all these things, turn them all off. Have everything as minimal as possible. These are kind of the colors that I use. I've made an Instagram post about them, but if you haven't already, these are the colors that I use. Feel free to just blindly copy them. They look sleek, they look nice. And the infamous blue that I use as well, that's this color code right here. So feel free to replicate that as well. But aside from that, you are then left behind with just a clean canvas, right? I see this as an art form, chart work. The cleaner your work is, the more like efficient your workflow, the tighter your annotations will be, and eventually the quicker you will see results. In that case, I'm a firm believer of that. And that's kind of how I want to wrap up the first lesson. A little bit of theory about candlesticks, cleaning up your charts just a little bit. We'll go over indicators a lot later in this sequence. But for now, I just hope that you have something that you can look at that you are content with, that looks clean. No psychological interventions with any potential triggers of buy side or sell side, whether that's red or green colors. I definitely just advise you not to do that. Keep it mundane. Maybe lower your brightness of the background color of that white. You can do that as well. That looks a little bit like this. So if you go to canvas again, you can change this. You could potentially go for this color. This is a little bit more darker, which is totally fine. And we'll go into the rest, such as indicators, later. But that's pretty much the first day. We look at charts, we get you set up, and I look forward to seeing you guys on day 2. That will be tomorrow.